All right, we're going to get started. Good afternoon, everyone. Thanks for joining us today for our webinar, and it's all about note investing with Joshua Andrews. Before we do get started, just a few things. A new view, we are not attorneys, we are not CPAs or financial advisors, we are non-fiduciary, but we do provide you the third-party custodial needs that you'll need in order to self-direct your IRAs. We do not endorse any products or services. So we custody about $1.4 billion in client assets. NewView has been in business since 2003. We provide alternative asset choices, a wide range of choices for clients that you normally wouldn't be able to invest in traditional stocks, bonds, or mutual funds. And we have about 47 trained employees. One thing about NewView is we're simple to do business with. We are available and responsive. We actually get graded on our response time. Every week, we like to reflect that on our scorecard and see, if we try to get 100%, but we will get back to you as soon as possible. We never leave our emails unread, and we try to answer our phone call by the second ring. So these are big goals for us. And I just want to introduce Joshua. I'll give you some background on who Joshua Andrews is. I'm very excited to introduce him. He is the managing member at Paper Profits. Joshua Andrews is the author, like I said, of Paper Profits, How to Buy Profit from Notes. It's a beginner's guide, and it was published in 2017. This book, more than any other, has helped demystify the opportunity notes and mortgages provided to the everyday investor. Since 2012, Joshua has been actively buying and selling and modifying distressed mortgage loans. He specializes in non-performing and distressed assets. And in addition to his own portfolio, he does mentor other investors looking to invest both actively and passively, with an emphasis on assets that are secured by real estate. And his specialty is asset due diligence, market data, and forecasting. So with that, I want to introduce Joshua Andrews.
All right, thank you. Before we get started, one of the things that is really boring, but I have to say is that with regards to standard disclosures, this is not an offer to sell anything. We're not trying to get you to buy anything. This is just educational content only. And so any examples that we use, any figures that we talk about is just that. It's just as an example. So I want to say thank you for taking the time out of your day to view this with me. And I've been told I have about 30 minutes. So just to let you know, if you're not familiar with notes already and just the general concept, it is very difficult to dive into and answer every question, obviously inside 30 minutes. So what I would suggest is at the end of this webinar, we do have an offer to give you a free copy of my book, Paper Profits, which goes into very deep detail about the note business and about how to analyze these for yourself to determine if this is possibly a good investment for your portfolio, and also how to buy them in IRAs. All right, so let's go to the next slide. So just a little bit about myself, my experience with mortgages, kind of how I got started, where I came from. So I grew up in a very small town in North Idaho, and that town is called Sandpoint. If you've heard of it, it's a really beautiful place, but there's just not a lot of opportunity there. It's very small. So I ended up moving out of that, and I now live in Austin, Texas, which is home for me. I've been here for about 6 years. So ever since I can remember, I've been very passionate about financial freedom. It doesn't really matter what the investment vehicle is for me. It was more or less, how can I develop a system to produce passive or semi-passive cash flow to live on and have the quality of life that I wanted. I've been investing in mortgage notes specifically since 2012, and I started with my own money and kind of built up from there. I read a lot. I read a lot of finance, banking, economic books. It's just kind of something that I've always been interested in. And while we do notes, my specialty is actually second position mortgages. And I'll talk a little bit about that, but in general, we're going to talk about just mortgage notes, what they are, how they might fit into your portfolio, and just some basic concepts. So one of the things I think is really important for us, for most investors, is having a why. What is your reason for investing? Now, most of us will say, well, I want to make money, or I want to retire, things like that. But it's really not that we want to make money. There's something in our lives that we want, and that money will help us fulfill. And for me, what that is, quite simply, is being able to do what I want. And that may sound silly, but for me, what kind of drove that home to me is spending some time with my family and determining that in order to have free time, I needed to have enough money coming in passively so I could spend time the way I wanted to with my family, with my friends, etc. So just really quickly, on the left is a picture of my dad and I that he took a little over 30 years ago by a stream on our property that he has. And I went to visit them for Thanksgiving a couple of years ago, and my mom and dad showed me this picture, and they said, wow, this is really one of our favorite pictures of us together with my dad and I. And so when I left, we took another picture, in real time, a couple of years ago, by that same stream, which looks quite different. And my dad and I obviously look different. And to me, that's what money does. It gives you time to spend with how you want and with who you want. And to me, that's what's important. Not to have shiny, flashy things, but just to be able to spend my life in my own way. And so that's my why. Like we talked about at the end of this presentation, what I'd like to encourage you to do is to go to this website here, and we'll give it to you again, to get a free copy of my book. We'll ship it to you, no charge. There's nothing in it but just really, really good, solid educational information, specifically about notes for the beginner. So any answers or anything that I haven't touched on in this presentation, and there probably will be a lot just from a time constraint, you'll be able to pick up out of this book. So let's talk a little bit about notes and mortgages and what they are. If you've invested in them before, this is pretty basic, but essentially a note and mortgage is just like you'd have on your home if you have a mortgage. It is a debt obligation that's secured against real estate. So it's real estate backed. The note is essentially the IOU, which spells out the agreement of the loan. So the terms, the rate, the monthly payment, when the maturity date is. The maturity date is going to be when the entire amount that was lent is due. And then the mortgage goes kind of in tandem with that. The mortgage is the actual security instrument that is against the property. So usually this can be a single family property, it can be multifamily, it can be commercial. You can put a note on a lot of things, but the mortgage is a security part of it, where if the borrower doesn't pay you per the terms of the note, then you use the mortgage as essentially leverage, where you can foreclose against the property, you can collect and recover your capital. So that's one of the things that makes this asset class very appealing, is even though it's paper, you have real estate backed, backing your investment. Oh, having some trouble navigating these slides here. So types of notes and basic terms. Obviously, we've all heard about first lien mortgage notes. There's also a lot of different mortgage notes beneath that, and it's just really when they were recorded in time. So the first in time, first in right is what it's called, means that the first lien that was recorded on a property's title has seniority of collection, meaning if the property is sold or refinanced or there's a foreclosure, that first lien typically needs to be paid first. And second lien would be the same thing, would be second in line to get paid, and so on. And you can make as many notes below the first as you'd like. I've seen 5, 6 liens on some properties. The thing to keep in mind is that the collection, whether it's a first lien or a third lien, that secured lender has all of the same rights to foreclose and collect their balance. So it's not just the first lien that gets paid, it's any secured creditor. Now, another term to understand is performing. Now, performing just means paying as agreed. So the borrower has a note and mortgage, just like any mortgage you might have. They're making monthly payments per the agreement, and that's a performing note. Everything's great. You're just collecting that check every month, or your IRA is collecting that check and building up passive income to go reinvest again. Non-performing simply means it's stopped paying. So non-performing means that they've got the note and mortgage, you still have the security instrument, it's still backed by real estate, but for one reason or another, the borrower has discontinued payment. Now, there's a variety of reasons that could happen. Could be death, job loss, divorce, illness. That's primarily the reasons borrowers stop. They don't just wake up one morning and say, hey, I'm not going to pay my mortgage. The other term is reperforming. So reperforming is where a loan has gone delinquent, it's gone non-performing, and then somehow it becomes repaying or starts to be paying again. So an example would be, let's say a mortgage stopped paying for 6 months, and the owner of that loan called or did some sort of collection action, worked out a deal with the borrower, and then now they're paying as agreed. That's a reperforming loan. So it was once non-paying, now it's back on track. And if it's done correctly, it should stay on track. So in notes, just like real estate, there are a lot of other asset classes or other niches you can really get into. So I won't get too deep into any one niche, but really you've got commercial, single family, multifamily, anything on real estate should be secured with equity. I would not invest in anything that's not. Lots of other note types could be, like auto notes, unsecured notes, things like that, which I don't recommend. Ourselves and my experience, we're focused on single family homes. These are residential properties that families live in. So these are occupied properties, well kept. These are not vacant, low value properties. So why are notes a superior investment? There's a lot of reasons, and my book covers this in much more detail, more time than we have here to discuss, but really what might make these good for a portfolio is you have real safety and control. So unlike stocks or a lot of other investments, you're just owning the paper, but you have it backed by the real estate. So you have it backed by tangible collateral, so there's something to go take if something goes wrong. Now, it doesn't always work out the way you want it to. It is an investment, so nothing is guaranteed, but there's a lot more control there and a lot more security because you have something backing it. One of the other nice things about it is you decide the rate of return. So, if you buy stocks or other types of investment, you're basically trying to buy low and then sell high in order to recoup money and make a profit. With notes, it's different. You are buying basically an annuity stream. Think of it as like an annuity where you're putting down a lump sum of money and then you're getting dripped payments, just like you'd make a payment to your mortgage company every month. You're getting that every month. And a part of that is a return of your principal, and a part of that is a return of, or interest, basically, your profit every month. So when you buy these from the outset, you're already calculating, if I hold this from now till maturity, what is my overall annualized return? And so you know that. As long as the borrower continues to pay, you have that pretty much dialed in up front. So it's much more predictable. You can say, well, if I'm going to buy several of these for my IRA, here's what that would look like as this kind of snowballs over the years and I reinvest this money. In general, conservatively, here's what I would end up with. So you have a lot more control with this type of asset. Another really great thing about notes is they're discounted. So a discount is, for some people, a little tough to wrap their head around, but once you see it a few times, it makes sense. So a discount's really where you're buying the note, your cash out of pocket is for less than what the borrower owes you. A good example would be, let's say you're buying a note that the borrower owes $60,000. It's a note and mortgage, and you're buying that, it's performing. Well, you might buy that $60,000 debt for $45,000. Well, why would you do that? Why would anybody sell that in that manner? There's a few reasons. One of the reasons is you need to be able to get the rate of return you need. And depending on what the borrower is paying, on the face value of their note, their interest rate, you may need to pay less than what they owe in order to get your return. And we talk about that in a lot more detail in the book. One of the reasons it's discounted too is you don't want to pay exactly full price, because there's always the chance that the borrower could pay off. So if you paid, let's say, for example, $60,000 to buy that $60,000 note in your IRA, and 2 months later, the borrower refinances, they would pay you in full, but you'd make next to nothing. It would be kind of a wasted transaction for you. And so you want to hedge against that and just assume, if I hold this whole loan the entire time in my IRA, what's my return? And so that's one of the reasons why you do discounting. A third reason you would discount is really that, payments you receive farther out in time are worth much less, because you have the time value of money going into that. So in general, that's the reason notes are discounted, and it's a very common practice between buyers and sellers. Just to kind of go through this again, notes are largely a very passive investment. So they're not like real estate at all, where even though they're secured by real estate, you have zero liability or responsibility for that property. You have no upkeep. You're not worried about the taxes. You're not worried about the roof, the toilets, the tenants. There is no tenants. There's the owner. And the owner has a much different mentality than a tenant does. This is their house. This is where their family lives. And so they're going to take much better care of it typically. So you're involved in real estate without that real estate part hassle. The only exception is you don't own the house. And I want to be very clear about that. You do not own the property. You own a lien or a claim against the property for a certain amount of money that the borrower owes you. That's all you own. So essentially, you're just buying paper, pieces of paper that are income streams. So what are some of the ways that you can begin investing in notes? I mean, there's a lot of avenues you can take. So for the passive investor, these are very easy to purchase in an IRA, and we'll discuss a little bit about that. You can do several things. You can do what I did when I first started, which was buy and hold individual performing notes just for the long-term income. My first purchase was with money from my IRA, and I spent $19,000 to buy a performing note. And I just wanted to see how it worked and see kind of the purchase process and what was involved, and obviously make sure that I received payments, because this was a new thing for me. So I wanted to make sure that, is this real? Am I going to see that money coming in every month? And I got hooked. I got very excited about it. So one of the ways you could do that is just buy individual performing notes with good equity, solid pay history, something that you're comfortable with inside your IRA. And that's a very simple type of transaction to do. You just title it in your IRA name, and every payment that the borrower sends would go directly dropped into your IRA account every month. And then when you have enough money built up in there, you go out and make another investment, and you kind of snowball that over time. Another way to do that is you could partner. If you don't want to own individual notes and do all that work, you could just partner with an entity that, or an expert or a mentor that already has some sort of investment vehicle that's passive setup, where you just contribute the funds and they go out and source the assets and provide a return, and et cetera. And there's a lot of companies out there that do that, ours included. It's not for everybody, but it's a good idea for people that it makes a good fit for. If you want to be an active investor, so if you want to do this full time, the opportunity there is to do just like we said. You can buy and hold individual performing notes, whether it's in your LLC, in your IRA, however you'd like to do that. You can also buy non-performing assets. Now, I'll try not to get too far into the non-performing side, but really non-performing is notes that stopped performing. You buy them at an extreme discount, maybe 30 cents on the dollar. And then you put them through a very specific process, get them reperforming, and then sell them for 70 or 80 cents on the dollar. So that process obviously takes a lot of expertise and time, but it's highly lucrative. And there's a lot of companies, large and small, that do that. It's not quite as easy as just learning to do it overnight. It takes, definitely some expertise, but you could learn that if you're dedicated and you have the time. There's very high returns in that respect, but it is more of a active, get your hands dirty, full-time type of investment. And then, there's everything in between. You can flip notes just like you can flip houses. If you get a good deal and you don't want to buy it, you can turn around, mark it up, and flip it to someone else. That happens all the time. You can do note partials, which is buying a performing note, selling a piece of it to recover your capital, and then keeping the rest. And that's a little bit more of an advanced type of topic, but I'd be happy to talk with you about that. We just don't have enough time here today. So there's a lot of stuff you can do with this that is pretty much always, I wouldn't say always, but most of the time a win for the lender, you. So both are very viable types of investor, whether you're an active investor or a passive. What really matters is not the return so much, but how much time do you want to dedicate to it? How close are you to retirement? That's a big deal as well, because the normal thinking is the closer you are to retirement, the more you just want that steady, just passive type of income in order to be able to live off that or utilize that sometime in the near future. So that's more or less your determination of what makes sense for you as an investor. So what we do, our business model, I'll just share a little bit where we're focused at. So we don't do everything, or we don't try to. I've been doing this since 2012, like I mentioned, and primarily we purchase non-performing second mortgages, which I know sounds really scary. I thought it was too when I first heard about it, introduced to it. It turns out it's not. It's highly lucrative. It's not for everybody. I'll say that up front. It's not something I would suggest that you start in, especially if this is your first couple notes or handful of notes that you've purchased. What we do basically is we buy large pools of second mortgages on secured residential property. So we buy 10 or 100 at a time, and we get these from banks or credit unions or brokers, things like that. And so we pay a discount for those, and there's very specific criteria that we're looking at: due diligence criteria, values of the property, equity, the first lien needs to be performing and current, their property needs to be occupied, a whole bunch of different things. But basically what we do is we come in and we offer the borrower a deal. We say, we start the foreclosure process and we talk to them about settling the debt. And we make very clear to them that we're not trying to take the property. We don't want the property. We just want to come to an agreement on settling the debt. And so we usually work out loan modifications with them, payoffs, things like that. And we actually, out of everything we do, we only end up taking the property or owning the property through foreclosure approximately 3% of the time. Everything else we end up working out with the borrowers. So we do everything we can to work something out that makes sense for them, and then also for us and our investors. So I like first and second liens. There's a lot of ways to do this. I'll just talk a little bit about the junior liens and then obviously first liens as well. But junior liens, you can buy them at a much larger discount. Some of that is risk factor. Other of that is they're just smaller loans. You can think of it as like an option on the property where you are a secured creditor. Even in a bankruptcy, you're a secured creditor with collection rights. You have all the same rights as the first lien. You can foreclose, you can sell it at auction, you can foreclose and keep the property, you can turn it into a rental, you can do all kinds of things. But again, your main goal is to keep the borrower in the property if at all humanly possible. That's the right thing to do. Each loan, for seconds at least, has a lower purchase price, so you have much less risk. So an example of that would be if you're going to go out and buy like a first position lien, a non-performing one, you may go in and spend $70, $80, $150,000 on this one asset. So for that much money, it needs to work. It needs to be profitable. For seconds, we oftentimes buy these for anywhere from $10 to maybe $15, $20,000 each. So your cost basis, your entry point's much lower. There's a little bit more work involved with getting the borrower reperforming, but you have a lot less at risk per deal and a lot more upside. It's disproportionate, your risk versus upside. You can also own mortgages with seconds on much higher value properties. So if you're going to buy a first lien, which is great, I'm not knocking first liens, they're a wonderful investment vehicle. Typically, you're going to outlay more money per asset. And when you do that, you kind of pigeonhole yourself into a certain value of property. With seconds, it's kind of like an option. So you can get, a really nice second on a property that's worth $500,000 or $1 million. We do that all the time, and it's a great way because you have a much higher value property, and then you also have a different economic wherewithal borrower, someone who really understands, when you offer them a good deal. So again, like I mentioned, really the play with this kind of model is you buy them for 30 or 40 cents, you modify them maybe over 12 or 14 months, and then you sell them for 80 cents around there. So there's much higher yields on a portfolio level, but this is a very, very active type of model. It's not something that I would ever recommend for someone just getting into this space. So due diligence is a really big deal on any kind of loan. Doesn't matter if it's performing, non-performing. Due diligence is really the cornerstone of, I would say it's 80% of the hard work on these things. And what you're trying to understand when you do due diligence on these is, what am I buying? What is the likelihood that the borrower will continue to pay? And am I okay if they stop paying? Will I be all right? Will I recover my capital? That's really the primary answers or questions that you're trying to answer. So when you're going through this, there's a lot of tools that we use, but you're looking at equity. Equity is really at the most basic level, the value of the property minus any mortgage liens on it. And so whatever's left over is your cushion of, if you ever have to foreclose or you had to do some sort of collection action, that's your cushion to get your money back. And lenders of all kinds look at this. The bank looks at this when you go to get a refinance or a mortgage. You want to get a visual on the property. In some cases, you're able to pull credit and look at the borrower's credit and kind of their past performance. You're looking at title reports. Title reports are extremely important. This shows you exactly what's on the property, what the borrower owes, all kinds of things. Who owns the property? Maybe the borrower that's being represented to you doesn't even own the property anymore. So title is a big deal. You're looking at payment history. So you want to see, how long has this person been paying? Are they consistent? Is there a big period of time where they stop paying? Why? You're looking at, in some cases, you can do background and employment checks and a number of other things. Just kind of create a bunch of different dots, data points, and then squeeze those together to provide yourself a picture of risk. What does this look like for me if I spend this money from my IRA? Would I be okay if this borrower stops paying? So you're looking in general for a lot of different factors with due diligence, but it's really, really important that you don't skip this step and that you don't try to skim through it out of excitement or just laziness, or just maybe not knowing. I would say get someone to hold your hand through this process, because it's the biggest part that's going to determine if you're going to make money or not. And then in general, just look for well taken care of properties that are not beat up, but that are, white picket fence, flowers in the front yard, a flag, things like that indicate people or the occupants care about where they live. And that's the kind of borrower that you want. So how you purchase notes inside your self-directed IRA is, it's just like almost any other type of purchase, really. You complete a normal purchase process with notes. You'd have a purchase and sale agreement with the seller, which outlines a bunch of different things. Typically, some IRAs do it differently, but typically they may actually sign that for you, or you may have a signature line that says read and approved by your name, and then it would be titled in your IRA name specifically. So any money generated from this note would never touch your hands, it would go directly to your IRA. You would give all of these documents to your IRA provider, and you'd also give them funding instructions, and they are going to have, essentially, I would guess, a couple pages on their side, administrative-wise, that you're going to fill out in order to facilitate that funding. Every year, you're probably going to have a fair market valuation and you could, it's a one or two page form. It's very easy to complete. Other than that, there's not really much to it. There's been a lot of questions about UBIT and if that's generated in your IRA. And I'm going to say offhand that I'm not a CPA. We have consulted with a number of CPAs, and as near as we can tell, UBIT is not generated by owning a note or by owning shares of a company that's purchasing notes. The reason for that is most of the time you're not using leverage. You're not generating credit lines. You're not using a mortgage to buy something like you would with real estate. You're just buying something with a lump of cash. So the purchase is really simple, shouldn't take that long, and you can buy these kinds of assets, any type you like really, inside your IRA, provided that you do the correct due diligence and then you complete the normal purchasing process. And I'm not sure how much time we have left here with regards to case studies. You jump in and let me know how much more time we have here, just so I don't shoot over the time.
Yeah, you're good. You got like 10 more minutes.
Okay, great. I just want to be respectful of time. Thank you. So case studies, we'll go over a couple really quick case studies just to show you what in our business, kind of what the second position lien looks like. Here's one. We purchased $31,000 and change of unpaid balance. This is what the borrower owed. This is a second position lien. We purchased this for about, I'm just going to round up here, let's call it $6,000. So you can see that's a very small basis out of pocket. The risk is fairly low. We put this through foreclosure legal, spent another $2,100 on it. So we have a total basis, 78 and change. We modified the loan. So this borrower really didn't have much to give us. We got financials and all that. They only had $500. So we took that for a down payment, modified the new loan balance to $31,000, 5.5% fixed rate, 20-year term. So you can see this is very lenient. We're not hurting this borrower in any way. We're actually making their term better from what it was. And the monthly payment's small on this one. It's about $217.09. So as you can see on smaller ones like this, it's not going to change your life having 2 or 3 of these. You're going to need to have a lot of them. What makes these really interesting when you buy non-performing and then make them performing is now you can sell this. Once you have a little bit of seasoning, you can sell this same loan where you've got $7,800 in it. You can sell this for almost $20,000, about $19,000 and change. And how you can do that is because buyers, there's a very strong market, secondary market for these types of assets once they're performing and once they have equity and a number of other factors. So usually you just buy it, hold it. You can hold it indefinitely or turn around and flip it and then use that money and do it again. Okay, and then case study number 2, same kind of deal. So this one here, we had unpaid balance that we purchased right about $73,000 and some change. And we spent $7,500 on this one. That was our out of pocket. We spent $4,000 and some change in legal collection costs. So our complete at risk out of pocket was about $11,500. Now we did the same thing with this one. We modified the loan. Again, similar scenario. Borrower didn't have a whole lot, so it was $500 down. We usually want a lot more than that. We modified this new loan balance to $50,000, so we forgave some of his excess balance. It's a 6% fixed rate, 25-year term, monthly payments $322.15. So same thing with this. You can turn around and sell this same loan after you've sat on it for a little while, receive payments in your IRA. You can turn around and sell this for 30 grand. And it's very easy to do that. It just takes some work and effort. And then, having some slide issues here. Let's go one more. There we go. And then occasionally what will happen on these types of things is you'll have a home run. And a home run kind of looks like something unexpected, but like quadruples your money. And it doesn't happen often, but it does happen. On this one, we purchased 66,000 unpaid balance. We spent 13,500, and then we spent quite a bit more. We spent about $5,100 in legal. So on this one, we have over $18,000 out of pocket or at risk on this loan. Borrower was uncooperative, did not want to do a modification, didn't want any kind of help, would never talk with us. So we completed the foreclosure. At auction, at the foreclosure auction, somebody else bid on the property higher than the amount we were owed, and then we were paid out at $85,000 at the foreclosure auction. So we never even touched the property, never had to manage the property, literally pieces of paper, and about a year, maybe 14 months, whatever that timeline is. Yeah, it was 14 months. So, you know, the ROI on that is extremely high because of our low cost basis and the very high upside. So it's one of the reasons that I like seconds. Again, this is just what we do. It's not the only way to invest in notes at all. And I think I may have skipped. Okay, so some additional reading and resources that I would recommend for you is really, I'd like you to get a copy of my book, Paper Profits, if you can. It's completely free. It's just education only. It's just about notes. So you can go to this link here, and I think we'll probably send that to you again if you have questions. You can go there, just fill out the information, be happy to send it to you. There's another few notebooks that I highly recommend just for education. One of them is by a colleague of mine called Martin Saenz, and it's called Note Investing Made Easier. Martin's a very sharp guy. He does a lot of work in this industry. Invest in Debt is another one, Jimmy Napier. This is an older book, but really, really good. And then if you like economics, most of us don't, it's a little bit dry, but this is a really easy to read book if you like just a real concise book on economics by Henry Hazlitt. Then Websites and Forums, Bigger Pockets is very, very good. You're gonna go on there. There's a forum called Tax Liens, Notes, Paper, and Cash Flows. And there's a lot of really good, helpful people on there. If you have questions about notes or if you have questions on, you know, whether you're really advanced or just starting out, it's a good place to go. Noteinvestor.com is an excellent one. I have no affiliation to any of these places other than my book, but Note Investor was really where I learned quite a bit myself. It's a lady who I've met several times. She does a wonderful job of explaining notes, what they are, how to invest in them. It's just a lot of good information there that I would recommend. And then mentorship, if you're looking for someone to really, really hold your hand. We don't do a lot of mentorship right now, but the noteinvestingmadeeasier.com, that's the same gentleman, Martin Saenz. He does a wonderful job. He's just very patient, very knowledgeable, and he does what he teaches. So he's not just a teacher, he actually does it himself as well. And then, like I mentioned before, go ahead and just get a copy of my book. And then if you do have questions after reading, I'd like you to read it first, but if you do have a lot of questions, feel free to reach out to me, myself and my team. We're happy to talk with you, really about anything mortgage related, you know, investing wise. We've done quite a bit in this niche and work with a lot of investment companies and a lot of IRAs. And so if there's questions, we'd be happy to help. Just reach out to us. And then finally, just a little bit on how to contact us. We've got some information there. That's myself on the left, and then my business partner, Jane, on the right. She does a wonderful job of just bringing people together and helps make my life so much easier with setting these kinds of things up and educating folks. So now maybe, I think we're about out of time. If we could open it up to maybe some Q&A.
Thank you so much, Joshua. That was really good information. My favorite part was the case studies, actually. It was nice to actually see some realistic figures on what it looks like to purchase a second lien mortgage note.
Sure.
So we'll go ahead and start with some Q&A here. Okay, so I have a question here. Can notes be purchased inside of a 401k? I'll go ahead and answer that one. Most of the time, if your 401k is still with your employer plan, they're usually limited to stocks, bonds, mutual funds, your traditional types of investments. However, if you have like a solo 401k, which is great for anyone self-employed, then yes, you can purchase notes in that type of a 401k plan, but it's something you'd have to discuss with your plan provider. Okay, I have another question here. This one's for you, Joshua. Do you service the notes yourself, or can they be outsourced, and any legal concerns with the servicing aspect?
I like this question. It's a smart person. So we never do servicing ourselves, and there's a number of reasons for that, but I would highly recommend that you use a third-party servicer. There's a number of good ones out there. One that I can recommend is a company called FCI Lender Services. It's called F as in Frank, CI Lender Services. And they charge about 15 to 30 bucks a month per loan. And basically what they do is they are your face to the borrower. They accept payments from the borrower, so the borrower knows nothing of you personally or your IRA, provide some protection for you, but they also send out statements, monthly statements to the borrower, end of year statements, things like that, that, you know, ordinarily is just not a good use of your time as an investor. So they're well worth it. And it provides a lot of insulation from legal stuff as well, because you're not having to, you know, pay attention to timelines and things like that. They're doing all that for you. So I would highly recommend that.
Okay, I have another question. What happens to the first if you start to foreclose on the second as the note holder on the second?
As crazy as it sounds, nothing. The first stays there because it's in the borrower's name. The first will not do anything unless they're not getting paid. And typically the first is held by a large bank. So Wells Fargo, Chase, you know, someone like that. And it's going to take them months, maybe even a year or two before they actually pull the trigger and do a foreclosure or anything. So while we're doing our thing, it's not hurting the first. The first is still there. What happens typically is it just stays on the property, and then we decide if we want to continue paying it, if we don't want to do anything to it because we don't have any liability. It's not in our name. And so that's why it's in the best interest to keep people in their homes. You know, you're not trying to take things from them. You're just trying to settle a debt. But the first stays, the first stays on the property.
Okay, I have another question here. Where is the starting level? 10 to 20K? I guess that question is more like average to get started on doing something like this.
Yeah, so if you're going to buy just a performing note for yourself, you could probably do it at $20,000. Obviously, you can buy notes for $5,000. The issue starts to become if it makes sense, or if the monthly payment you're receiving is exciting enough to do the transaction. So you can buy a note at $6,000 that you spend and get a $60 a month payment, right? But I mean, it could be a great way to start, but it's just not going to get you excited like, hey, let's build up a whole portfolio of $60 a month payments. It's going to take you the rest of your life. So in reality, I have found that, you know, if you could get around $20,000, $15,000, $20,000 and up, wherever your comfort level is, it's probably the best place to start to actually purchase a note and then grow from there. I mean, my first one was $19,000, you know, so just kind of in that range is probably a good starting point.
Okay, if an investor works with you, what is a realistic rate of return?
So it's going to depend, and that's one of those things where you know, on this webinar it was more education, and so that's kind of a question that I would say maybe follow up with us. Yeah, I'd be happy to talk with you.
Probably talk one-on-one.
Yeah,
okay.
I think that'd probably be better. But I'd be happy to explain, you know, what we're doing and how investors can participate. Yeah.
Okay, do you work with passive investors with self-directed IRAs?
Yes, we do quite a bit. I would say approximately 65% of our investors are investing directly out of self-directed IRAs, trusts, things like that.
Okay, somebody wasn't able to view the slides, but yes, the whole presentation will be available afterwards on newviewtrust.com's website, and it'll be under our blog section, and it should be posted by the end of the day tomorrow. So for anyone that came in late or missed any slides, or you want to just be able to rewatch it because there was a lot of great information, it'll be available on our website tomorrow. Okay, in your experience, what is the ratio of successful deals versus deals which go bad?
That's a great question. So it's going to depend on the type of assets you're purchasing. So if you purchase performing notes that you've done really good due diligence on, have solid equity, things like that, it's rare. And by go bad, I mean like legitimately lose money. Not that a borrower stops paying and gets back on track, but like you lost cash. It's really rare. It's probably, 2% of the time. Now, if you're doing non-performing assets, which is much higher risk, but also much higher reward, and you're buying these things non-paying, typically in that type of scenario, what we found is about a 7 to 8% loss ratio on the entire pool. So, out of 100 loans, 8 are going to go bad, just to where you've done the best you can, but for some reason it's just uncollectible. So it depends on what type of asset class you're talking about, but it's actually much lower than most people think.
Okay, the next question is, can we invest directly with you instead of learning all of this myself? So that would make you a passive investor. And same thing, you talk to Joshua or Jane one-on-one, and they can discuss, what the qualifications to do that are.
Yeah, that'd be fine. Yeah, we do have a few different vehicles set up, but again, it's one of those things where I prefer just to learn a little bit about the investor and what their goals and needs are first.
Is there an average rate of return that you can expect? And can you get out anytime, or are they illiquid? Sorry.
Yeah, so the notes itself, so again, if you're buying a performing loan, just a standard performing loan for your IRA, you can get out. I wouldn't say anytime. The first question, rate of return, usually you're going to find assets like this anywhere from maybe 10 to 13%, maybe 14% on the high side yield. So yield is a different calculation than a straight interest rate. My book goes into a little bit about calculating that, but in general, performing loans, you're going to look at maybe 10 to 14% annualized return, as long as the borrower's paying and everything's fine. You can get out per se or become liquid. It's not, it depends how liquid you need to be. So in other words, we usually sell performing loans inside of a few days, maybe a week, but you have to find a buyer, and then you have to, obviously have a clean loan and a good asking price. So it's not as lengthy as a traditional real estate transaction. It doesn't have all those moving parts. So it's not like the stock market where you can just go sell it that day. But I would say if you have enough heads up, hey, 30 days from now, I'm going to need this cash. Yes, it's fairly liquid where you can sell that. You can sell that asset fairly easily.
This is more from myself. So what would the process look like when you are trying to sell a performing note?
So the process, probably two things. You're either wanting to get your money back, recover the capital, or make a profit. So you have to figure out what that number is. And then you would go to a broker, a note broker, which is just a middleman who knows a bunch of buyers and sellers, and say, here's an asset that I have. Or you could actually go to somebody like us, our company, or other companies and say, hey, do you know anybody who would want to buy this asset? I need to sell it within whatever time frame. And then usually someone who does a lot of transactions like that will say, well, here's my honest opinion of what I think you can get for it. How soon do you need to sell it? And then they could decide if they want to buy it themselves or go out to other parties. But it's not too difficult. You just need to have a little bit of time, to find the buyer, negotiate the transaction, and then get the cash.
Okay, has COVID made it challenging in your ability to foreclose?
Yes, absolutely. So COVID, there's a number of things going on with that. And a lot of the states have different regulatory timelines. And it's kind of a hodgepodge of you can do this, can't do that in various states. And so for us, it hasn't changed our model fundamentally, but what it does is some states right now, you just can't do any collection action at all. And with that, you know, you just sit and wait until you can. So there are some loans where we're not able to do much until the beginning of next year. And then some loans are totally fine. So there's definitely been an impact for sure. It's just not a game changer for us, but there is a definite impact on it.
Okay, this is a really good question here. In your third case study example, where you bought the second and you foreclosed, why didn't the first get a portion of the sale amount?
That's a great question. So whoever starts the foreclosure first gets to sale first and gets satisfied first. So in other words, you can think of it like the first was being paid, and they don't care what happens to the property because there's still a secured lien on the property. Even at auction, when we foreclosed from second position, the house went to auction. So foreclosure auction in that state, every state's handled differently. I think at that state, you know, people actually show up and bid, third parties. Well, we bid as the lender what we're owed. So whatever that amount was, that's what our bid was. Somebody bid higher, they cut the check, we get paid off, we go away. This person owns the deed to the property now, but the first lien's still on the property, right? So this buyer paid us the 85, first still attached in the borrower's name to the property, but the borrower now, or the buyer owns this property, the deed ownership. So now this buyer, now that he owns the property, he can do whatever he wants. He can pay this lien off. He can not pay it, in which case probably a year or two, they're going to come and foreclose and take the property from him. He can continue to pay it and live in the property. He can continue to pay it, rent the property out. He can turn around and sell it. There's all kinds of stuff he can do with it. I think in this specific transaction, the person that bought it at auction may not have realized or done their due diligence that there was actually a first lien on the property. They might have thought it was a first that he was buying. You know, and so that does happen. We've had that happen a couple times. So the first doesn't get paid off because they are not the ones being satisfied. They're not the ones delinquent. It was our lien that was delinquent. We were the ones that went to the foreclosure sale.
All right.
It's kind of strange, but it's the way it is. Yeah.
Yeah, that's interesting. That was new for me. Okay. Does it have to be in a self-directed IRA? Love that question.
No. So you can buy these in anything, almost anything. If you have, like you were saying before, if you have a different type of IRA, it needs to be self-directed or have the capability to buy alternative assets. You know, so if you have something at Charles Schwab, probably all they're going to let you buy is stocks and mutual funds and whatever they're making a commission on. So if you're buying it in some form of retirement account, it needs to be self-directed to where you can direct buying an asset, alternative asset like this. But if you have cash, if you have an LLC, if you have a trust, you can definitely buy these in that. I would not recommend buying in your own name just because there's some liability there, and that's what the borrower would actually see as the owner is, you know, Jane Doe and then your home address. So I would have an LLC or something as the buyer.
Is there an average range of returns? I'd say maybe compare like secured versus unsecured notes.
So we don't do any unsecured, but as far as rate of return for performing notes, you're probably looking at, like I said, 10 to maybe 14% on the high side as far as an annualized return. And that return is calculated based on buying now and then holding that entire income stream to maturity. So, you know, you don't know if that's going to happen. The borrower might pay off or refinance partway, but that's kind of what you're looking at for performing assets. Yeah.
Okay. Okay. Who do you contact if you want to purchase your first note?
I mean, you could definitely contact us. We can point you in the right direction. I can give you some resources and people to talk to, introduce you to brokers and things like that. We sell notes on occasion from a couple of our funds. So we do have stuff to present. Like if somebody said, hey, you know, I have X dollars to spend in my first note, we could put you on our mailing list, or we could introduce you to note sellers. Yeah. But you would need to do the legwork as far as the due diligence and kind of, you know, figuring out what you do or don't want when you're buying.
And then can you repeat the name of the company that services the loans?
Yes, it's F as in Frank, C as in Charlie, I as in Igloo, so FCI Lender Services. They're excellent, excellent servicer.
All right, that wraps up our Q&A session. And thank you so much again for joining us. That was very informational. And if anyone that attended today would like to learn more about self-directed IRAs, feel free to text RECEIVE, and I'm sorry, it's text NOW, capital NOW, to get our e-guide, and you're going to text it to 3339. Or you can call us at 877-259-3256, or you can email us at info@newviewira.com. Thanks a lot, everyone, for joining us, and you guys have a wonderful rest of your day.
All right.